All right, we're ready to resume and take the next step in the presentation process, which is Commissioner Zuniga and the finance.
Thank you. Thank you. Good afternoon, everybody who's ever watching at home.
Afternoon.
Good afternoon.
I'm again turning my back to our audience, but that's for the benefit of commissioners and those at streaming. I will be presenting the category of finance here today. I have the little disadvantage in following pictures with numbers and following lunch, but hopefully we'll get through like we have done in the past with a good summary and a good discussion. So I'm going to give a brief overview of the operations of the applicants. The applicant for the Revere location is Mohegan Sun, Massachusetts. It's an entity indirectly wholly owned by the tribe Mohegan of Connecticut. They own their flagship operation is in Uncasville, Connecticut, which has 5,500 slots, 325 tables, and 1,200 hotel rooms. The year ended on September 30th. I believe that is for 2013. The gross gaming revenues were $862 million. The tribe is also owns and operates the Mohegan Sun at Pocono Downs in Pennsylvania. That is a smaller facility that has 2,300 slots, 80 table games, and they do conduct live harness racing. The revenues for that same period amounted to $183 million in 2013. The tribe manages the resort's Atlantic City Casino. They do have a minority ownership there. They're also currently competing for a gaming license in New York State. And the capital costs reported there are $550 million of capital investment with 1,800 slots and 50 table games. Importantly, I need to highlight that if successful, this applicant, if successful in obtaining the Region A gaming license, they will transfer 60% of ownership of the operation of Mohegan Sun, Massachusetts, over to Brigade Capital Management, their financial partner. And I'm going to be getting into more of those details later on. Wynn, on the other hand, is a wholly owned subsidiary of Wynn Resorts Limited. They own and operate two big operations in Las Vegas with 230 table games, 1,850 slots, and 4,700 hotel rooms. Their gross gaming revenue is $683 million for 2013 in the year that ended December 31st. They have different fiscal years. They also own and operate the Wynn and Encore in Macau. We saw renderings on Commissioner McHugh's presentations there as well. They are larger operations, especially in the table game arena. But they also have a lot of hotel rooms there with 1,000 hotel rooms. The gaming revenue there is no surprise, is significantly higher than those of United States operations at $3.8 billion. And they are currently constructing the Wynn Palace in Macau. The completion date is estimated to be somewhere in 2016 with a capital cost of $4 billion and a 1,700-room casino. I hope many of the people watching can see this. It's meant to be a brief summary of the operations. The construction period, and one thing that I'm going to do throughout my presentation is we kept Springfield, the operation in MGM that has already been tentatively awarded, because I thought it gives a good frame of comparison for a lot of the things that we'll be talking about. The Mohegan is usually at the middle of charts that include all three operations, and Win is, again, for alphabetical purposes, towards the right. The number of seats, a big difference is relative to the slot machines that one proposes versus the other applicant. There's a lot more emphasis on slots in the Mohegan application, and there's less so in tables compared to the split that is evident in the Win application. And a little bit of that starts to explain the different market emphasis that both applicants come and are bringing with their proposal. This is a theme that is going to go through certainly through the finance section, but there is later on I'm going to be asking Rob Scarpelli to look at, or actually to explain, the market assessment, which is also an important piece of this application, or of this evaluation rather. The mix is here is just a sample of the entertainment and retail options. The seats are slightly higher when it comes to food and beverage, but they have similar number of outlets among the two applicants. As highlighted by Commissioner McHugh, the retail includes a specialty kids quest area, whereas a Win, worthy of note, is a nightclub with a multi-purpose venue. I think it always bears reminding ourselves of some of the way that the finance section was organized and how it mirrors the goals of the statute when it comes to the financial pieces. There are 4 broad areas that really align with, that come from the statute directly, that I'm going to be talking about. And that is how they're organizing themselves in terms of finance and capital structure. A big goal of this statute relative to the finance section is, of course, maximizing revenues to the Commonwealth, realizing the maximum capital investment, and we have a minimum threshold that I'll be talking about shortly. And something that I think is very important, because I think it's a catch-all that captures rather a lot of what permeates in the finance section, is offering the highest and best value, but at the same time creating a secure and robust gaming market. It is a new industry, after all, here to the Commonwealth, and we all are very vested in making sure that it's off to a good start. And this is the first step, the evaluation. There are a number of questions that were not rated. I'm not going to go into, for time purposes, I'm not going to get into them. But these 4 areas are really encompassed by many questions in the finance sections, but elsewhere as well, that we reviewed in terms of trying to assess and compare for those objectives. Let me just stay there for a minute. I just want to emphasize that all these major objectives, the ones that are in Section 18 of the statute, I believe there were also 18 big objectives. No one applicant can really maximize all of them. They are, in my view, at times competing objectives. I think the shorthand has become maximize the good while minimizing the bad, and of course, that really transfers or the way it comes to fruition is the fact that it's going to be very hard to maximize all of them, even if it's minimizing or mitigating the negative consequences. So of those 18 interrelated objectives, and there's going to be a theme here today relative to how some of these issues interrelate to each other. There's 4 that I just spoke about in the previous slide and are here again that are key to the finance section. When it comes to maximizing revenues to the state, I believe, although it's not clearly stated in the statute, we've taken and interpreted that this implies revenues from near and far. And as we will be talking into how some of these sections interrelate with other sections, like economic development, there's many topics, in my view, that overlap as was discussed this morning. We also have something that I think bears reminding ourselves in terms of these objectives, and this is that the way that the legislation was crafted was to expressly limit 1 casino license per region. And something that's also very important is that compared to many other states that have enacted expanded gaming throughout the states, ours is one that's viewed as a low tax rate and with a high minimum investment threshold. We've had a lot of discussions relative to that 500 million capital investment. The way to really offset or realize that is with a low tax rate, which is 25% of gross gaming revenues in our case. I'm going to mention the people who advised me in this endeavor. The people from HLT, Rob Scarpelli to my right, supported by Katia Muro, Drew Chamberlain, and Matthew Klass. All did great work and have been doing great work for us in this. Not shown here are Derek Lennon, our own CFAO, Michael and Carol to my left, and Alan Lebovich, a former commissioner of DOR, who was very helpful in helping us try to craft the summary presentation today with all of the data that we have. So the 4 sections that I'll be doing today are no surprise what we've done in the past 2 evaluations. There's a financial capability, and it has to do with obtaining project capital. We have a review of the financial strength and the expected project returns. I'll be talking about the investment plan in terms of, and that is essentially their budget, their capital budget. I'll also, later, as I mentioned, Rob is going to be talking or helping me present the market assessment, which is the framework that HLT did for all of the applicants in this process. We started with Category 2s and went on to Region B, and we are now in Region A. And there's also some discussion that I will have for us today relative to the operations plan. I want to highlight something very important, which are 2 key words here, and that is the consistency between many of these very interrelated areas. In some cases, we do not touch as to the relative merits of going after one particular market area or another. A big part of what we do here is understanding that if they say they're going to go after some market, whether that was reflected in their financials and or whether that is consistent with what they propose in terms of capital investment. So let's just start with the financial capability. The specific area that we review here are their ability to obtain capital to build this project. These are very large, complex, and expensive projects, so this is a a central piece here. We do review their current financial strength because that has some bearing as to their ability to react to competitive forces and come up with additional capital if needed, for example. And we also look at a very detailed, on a very detailed basis, the expected project returns over the 15-year term of the license. The one thing that I will highlight here, which I've done before, I'm just going to breeze through this quickly, is that in this case, there's a lot of information that we have available, not just from the application, which was initially quite copious, but there's a lot of SEC filings, annual reports, public representations that the applicants have made. Of course, the phase 1 suitability reports are still documents that have a lot of bearing into this analysis. Even though Mohegan is not a public company, they do borrow from the capital markets, and in a very similar way, they are able to, there's a lot of public information that's available, analyst reports, rating agencies, ratings, and the like, and all of that has been analyzed by the team of advisors that I have, and has been a big, important background into all of this section. So here's a summary of, or a snapshot, or a summary of the proposed funding plan. I want to just emphasize or hone in on this number a little bit. It's been reported quite a bit that the Mohegan application is a $1.3 billion application. As submitted as of December 31st, it's a $1.1 billion application. The media reports have rounded up the Everett proposal, or the Wynn proposal, but the detailed number is there. It's a $1,589,000,000 proposal. I'm going to get into the details of these numbers in a couple of slides. The applicant at Mohegan proposes to fund this operation with third-party debt of approximately $800 million. Comes with $235 million in equity, and I'll speak about the detailed numbers here in a few minutes, and will obtain third-party funding, which includes some of the retail tenants, as well as this third-party or the second hotel that Commissioner McHugh spoke about this morning. And we're going to get into the details there as well. But if we take the numbers as presented by the applicant in terms of their debt to equity, the ratios are 71 to 21. I'm going to come back to these numbers for the Mohegan application because certain elements of the stated equity, in my opinion, the $235 million, do act and behave like subordinated debt. And I'm going to explain why that's relevant, and again, in the next few slides. The Wynn proposal proposes to borrow approximately $984 million. They bring $600 million of their own money in terms of equity, and that does translate into debt to equity ratio in this fashion, approximately 38% of equity. Here's a detail that I was talking about a little bit. For Mohegan Sun. There are two numbers that are worthy of note when they, because they come under the classification of equity, that have been already spent or will be the spend to date when it comes to pre-development or chase costs. And that's because there's two parties that arrived to this point. They had in many ways, a lot of efforts with a different party in one case and in another site in another case. My view and opinion of this $100 million in what they call equity is that that's a sunk cost. Brigade proposes to bring in as common equity 50 million in financing, and they also bring a preferred equity component of 60 million. There's a difference into these two financing. One of them, and I believe I have a slide later on, but I'll just summarize it here. The common equity is what, in my view, really behaves like pure equity, gets paid at the end, gets paid last after all the distributions and commitments are made. Conversely, the preferred equity has a stipulated rate of return that is paid, that is guaranteed, if you will. It's really stipulated, and is payable on a periodic basis, but not for the first few months of the construction. It starts accruing interest right away, and the party, Brigade, has calling rights on that equity after 5 years of the investment. There's also a third party or key money, as was discussed in the past. Developers who are familiar with retail from this area, New England Development and Finard, proposes to bring 20 million as upfront money to the development of the third-party hotel. Debt is broken out over there. It is the 807 million that I talked about. 730 million or thereabouts would come from a bank, from an investment bank. And the proponent proposes to lease the equipment when it comes to the gaming equipment, although it's going to be backstopped in case of additional costs also by Brigade. There's additional third-party funding. The tenants that the operation ultimately goes and gets are going to be required to do tenant improvements or fit-out in the amount approximately of 30 million. There will be the third-party hotel equity that I talked about earlier, and there will be third-party hotel financing as well in order to put this operation together. One important thing that I think is worthy of highlighting here is that Brigade has a couple of different, is wearing a couple of different hats here, has an equity position here, and because it backstops debt and other financing from other parties, is also in a debt position. I'm going to get into the details as to why these may or may not be something to think about because of the way the parties interact with each other. There's a future slide a little bit for that. I'm sorry that some might not be able to see given some of what's on the screen here, given some of the shading. But and I was also I need to talk about how the parties for the Mohegan application come together and interact with each other and finance some of the different components of the operation. As I mentioned, should the license be awarded to the applicant who's up here, Mohegan Sun, Massachusetts, Holdings, the entity that is owned by the tribe, would transfer 60% of its ownership to New England Gaming Partners, which is an entity 100% owned by the investment funds or accounts that are managed by Brigade. Through the clarification process, Mohegan confirmed that this document was applicable to the Revere site, although the document really stipulated the Palmer site. MGA Gaming, an indirectly wholly owned subsidiary of the tribe, will manage the operations of the casino and the casino hotel relative, and that is highlighted in a management agreement between partners and gaming. So there's a document that governs this equity commitment and this equity transfer, and that's the amended and restated limited liability company agreement of MGA Palmer LLC. Now, as I talk through these, and I'm sorry I'm going to spend a few minutes talking through this slide, I'll note that these are term sheets. They're detailed. There's a lot of detail there. But ultimately, the actual agreement or the actual agreements have not been executed necessarily, or have not been executed, period. There may be some details that would have to be ironed out between the term sheet, of course, and the actual agreement. Now, there's another document as part of the application, and that's the equity commitment letter, which is a joint venture of summary terms with the equity commitment in the Mohegan Sun at Palmer. I spoke about it already. It includes $50 million of preferred equity. They termed this preferred interest. 50 million of preferred equity, and then 50 million of common equity, 60 million of preferred equity, which is the preferred interest. The preferred equity is treated as debt between Brigade and Revere. It's entitled to a quarterly dividend that is calculated based on 15% per annum from the date of investment. And during the time between the date of investment and 18 months of casino operations, the interest accrues, it continues to accrue. The term for that commitment is 10 years. It's less than the value of the license. And this commitment is callable, meaning the investor can call it after 5 years. Those calling rights, if those calling rights are exercised between the years 5 and 6, the investor or Brigade is entitled to a premium because they are essentially taking that money with them. The premium slides down all the way down to 0 if the commitment is not called. Now, there's also another document that is very important to highlight, which is the ground lease between the project and or the partnership rather, and the landlord, which is Sterling Suffolk Racecourse. Sterling Suffolk is the landlord. They although it's stated that they don't have an equity contribution, they do have about 5% of the distributions. I will look at that in the next few slides. Their rent is tiered. It's very detailed. I'm not going to get into how it's tiered, but essentially there's payments that come. There's floor payments. Approximately $35 million a year during the operation period. It's adjusted by the CPI. And it grows, the rent grows if the gross gaming revenues grow. In our estimation, that rent payment could be, given the market assessment that we've done, that rent payment could grow to approximately $75 or $80 million a year. I mentioned, like the other documents before, the actual executed ground lease is not well executed. But the term sheet is detailed. We gleaned a lot of information, but between the term sheet and the execution of the document, there could be important details of note. There's a fourth document, which is a hotel and casino management agreement between MGA, or the project, and Mohegan. It establishes a base fee, a base management fee. I guess I believe that's at 2% of the net revenues. There's also an incentive fee. So the management of the operation is also tiered. There's an incentive fee that grows based on EBITDA, which is earnings before interest, taxes, amortization, depreciation, and in this case, management fee, because that's the basis by which the management fee is going to be calculated. That fee grows. The incentive fee is 5% of EBITDA under 200 million, and it grows if it's above that. The Hotel and Casino Management Agreement establishes a marketing restriction, which has been reported in the press, and I'm going to be talking a little bit about as well. There's a marketing restriction that has to do with the operator being able to. There's a marketing restriction program that will be imposed on the Massachusetts casino operation. I'm sorry, on the Connecticut casino operation. But it is the Massachusetts operation that sets the bar. There's been public representations that certain people in certain areas of the eastern Massachusetts zip codes will not be marketed to by the Connecticut operation. To be precise, those zip codes are going to be the Massachusetts operation will establish the baseline, and the Connecticut operation might be able to match those marketing dollars. But there's questions that I have about that. I'm gonna speak a little bit more about that later. Actually, I had my notes to speak now. And I think it bears for the record. The Mohegan Sun, Massachusetts, and other Mohegan Sun property databases in this marketing agreement or marketing restriction are to be kept separate and independent. There's a specified zone, and that's going to be in the next page, where this applies to certain zip codes in the eastern part of the state. At regular intervals, no less than once per month, there will be a review of the database to determine which customers within the specified zone can be marketed to that have not been enrolled in the Mohegan Sun, Massachusetts database. And Mohegan Sun, Massachusetts will not share names of acquired patrons in their database with the Connecticut, actually with Mohegan Sun's other properties. I've been saying the Connecticut operation, but it really applies to all the other properties. The marketing offers by Mohegan Sun's other properties may not exceed the offers put forth by the Massachusetts operation, but only within the specified zone. And the applicant, the document also stipulates that there would be a neutral third party that will be employed to implement the standards and procedures to ensure that the plan works as intended. There will be there's another document, document 5, that governs the way this retail, dining, and entertainment facility is funded or conceived. There's a term sheet sublease between the project and New England Development and Finard. this agreement states that in return for providing the 25% of the agreed construction cost for the RDE facility, it's labeled key money. I believe our Director Wells talked about that. They will have the right to operate the retail, dining, and entertainment facility. They will be responsible to pay Mohegan an annual rent equal to 8% of the project costs. And while NEDF will operate the facility, Mohegan will be responsible for the common area maintenance, as well as taxes and marketing, and will charge the NEDF numbers that are stipulated in this agreement. All capital expenditures for Mohegan and all sublease rental payments are for the account of NEDF. And all subtenants that NEDF leases space must agree to accept casino player card points or coupons as currency. This is an important part of their operation as well. So this term sheet is for sublease is submitted as part of the application, but again, the executed agreement is not final. There's a second hotel, and that has a separate set of costs and requirements. I'm going to skip to the main point, which is those details are articulated in the term sheet, but the agreement is not final. There's also other important documentation, and that is the capital lease. The applicant proposes to lease all of the equipment. There will be financing for the hotel. All of that has to be completed. And those are the players that come together in this application. I can pause there and ask if there's any questions on that so far.
I have a couple.
Okay.
So, in looking at this chart, one of the first things you talked about was percentages, and you mentioned 15%. I assume what you're saying there is that is more expensive than other financing, so that is more risky. Is that's where you were going with
that? Yes, I'm going to get to that
you are?
in a little
Okay.
bit. Yes.
Okay, and the same thing with callbacks, that is a risk if
Yes.
after 5 years, correct?
Yes. Well, the applicant proposes to bring equity, but that could, the 60 million of preferred equity, that could be called back and after 5 years. And this is relevant because, at least in my mind, equity is the sort of thing that gets paid last. Comes in first, but gets paid last. And what that begins to do, in my view, is starts to sound a lot like debt. And where I'm going with this in a little bit is that the more debt, the more leverage, the higher risk. So that's correct.
I thought so. And the last question I had was then you detailed some of the zip codes and the marketing agreements, and from my understanding of reading this and listening to you, those agreements don't necessarily protect Massachusetts. Is that was your point?
Yeah, and we're going to get into, it's not a straightforward yes necessarily, but I'm going to get into why I do have a condition relative to the marketing restriction. Or actually, we thought a lot about what that means. My biggest, where we start is, how is this really going to work? How is it implementation ready? And that's part of, and that's perhaps where you're coming from, because I know you've read the report. But I'm gonna describe as to why those things are of note.
Very good, thank you.
I had a couple of questions, too. Could we go back to slide 5 for a second?
Yes.
That refers at the bottom to the casino model. And could you explain a little bit more about what you mean by the casino model?
Yeah. So there's been a lot of states recently, like, and I'll mention them because they're very much, they're in the Eastern Seaboard. Pennsylvania and Maryland, for example, recently new expanded gaming jurisdictions. Their model was not to have was to have more licenses and high rate. The tax rate, you might remember in Pennsylvania hovers around 56% for slots. Or is that's 56 for Pennsylvania? I may have that number wrong, but it hovers over 50%.
I got it.
Right. Maryland the same way. And, in my opinion, that approach is perfectly legitimate, but results in a couple of different things. One of them is that you may have a smaller operation in terms of capital investment, because the more you tax it, the less that you're likely to get in terms of capital investment. But in order to really capitalize throughout the state, they might decide to do more of that. Again, because there's going to be less ability, the less of capital investment, there's presumed to be less ability to attract customers from further away. And if you're Pennsylvania, you might want to do that because you are responding to Atlantic City. And if the big piece of that was to try to recapture the market that was leaving, that's the model that they chose. Now, conversely, the Massachusetts model, in my opinion, mirrors a little bit more of the desire to limit the licenses, which we have. We're only precluded to 2 licenses, to category 3, I guess. And the lower tax rate of 25% and the high minimum capital investment of 500 million, which we have interpreted as excluding a lot of costs, is designed to attract customers from farther away, at least partially.
Okay, thank you. That's helpful. Could I take a look at slide 10 again?
Yes.
And just so I understand, I think I understand what you're saying, that the third-party debt is traditional borrowing, bank debt or whatever, the
Yes.
first line, right?
Yes.
The equity is equity,
Yeah.
in theory, and the third-party funding is a contribution to, a direct contribution to the capital cost. It's neither debt or equity.
Yes.
It's money advanced by a third party.
Yes.
Okay. And then on the next slide, the 75 and the 70 and the 35, the 2 top numbers, that's money already spent.
Yes.
So it's, as you described it, sunk costs. That's not money that's available to do anything else with. It's been spent on the preparations and the like thus far.
That's right.
The 50 is what we commonly think of as equity. That's equity.
Yep.
It's the last to be paid. It's an investment.
Yes.
The preferred carries an annual dividend requirement
Correct.
of 15%,
Yes. Per year.
and it's callable after 5 years.
Correct.
And what was the and the call can't be exercised after 10?
Well, the term is 10.
Well, the
So
term
if
is
it,
10.
yeah, so if it
has to be 10.
expires, it's, it's due at the time.
So it's due at 10 years.
Yes,
So it's in effect a short-term loan.
yes,
And there's a premium for
calling it early.
calling it early. A
Yes.
premium to the Mohegan Sun or a
No.
premium to,
A premium to Brigade, to the holder of the investment. So,
how does that work? So if they call it after 6 years,
yep,
they get 60 million,
plus
Plus.
7, no, 9 to
well,
10%.
just some amount.
Yes,
If they call it after 9 years,
yes.
they get
Just
the 60 million,
Yes,
just the 60 million.
that's right. But in the meantime, they would have gotten 15% per year.
No, I
And that's
understand-
what
I
offsets.
understand that. I understand that. What, okay. The key money is a contribution. All right, it's neither debt nor equity, it's money that the New England Development Fund is actually investing in the hotel.
I'm sorry, can I pause on that? Because Rob just,
Whispered something.
Mr. Scarpelli just corrected me, which is why we have them here. The board of Mohegan Sun, Massachusetts determines whether to call or not that interest, that investment. But it's controlled by 60% by Brigade. So it's the incentives are, it would be up to Brigade to decide whether it's in their benefit to call that equity or continue accruing the coupon.
So what role does the Mohegan Sun board play in the call decision?
The MSM board, Mohegan Sun, Massachusetts
Right.
board, they decide to call the
If, can I
yes,
interrupt?
please go ahead.
If after 5 years Brigade would like to have its 60 million paid
Right,
back,
right.
it would approach the board, which it controls 60% of, to determine if they get paid back.
Oh, so it has, okay, Brigade has to go to the board and get the board approval to call it,
Yeah.
but Brigade controls
Controls the board.
60% of the board? Okay.
Yes.
All right. The key money is the 20 million that Fennard New England Development is investing,
Yes,
and that's an investment, a direct investment in that second hotel.
No. So
yes, go ahead.
it's the investment in the retail dining entertainment sector.
Gotcha. All right. All right. And then the places where that indicates Brigade backstop, that means that Brigade will provide the money at some rate of interest.
Yes,
If it can't get it from a third party.
that's right. If they cannot either get it from a third party or cannot get the whole amount,
Right.
in other words, there's cost overruns, say,
Okay,
they will contribute the additional money.
okay. And that's why backstop is
That's
the
right.
secondary provider of that
That's
capital.
right.
Okay,
That's right.
good. Okay, thanks.
Can I go back, actually? I was reminded of a note from, on page 5, Melissa. Thank you, Rob. The secure and robust gaming market, I did want to address something that has been reported, and that is the competitiveness of the eastern seaboard. So as there's more operations coming online, there's the potential for more casinos in New Hampshire. Legislature approves that. New York has expanding. I did want to mention that's a particular area of focus, and I will be talking about that a little bit more later.
Okay. Are you going to talk more about the marketing restrictions?
Yes, but I can do that now if you want me to.
No, I'll wait to hear from you. That's it, thanks.
I figure, just back to the comment from Commissioner Cameron relative to risk, which I alluded again on the secure and robust gaming market. I did want to talk about because of all the parties here involved and how they come together, there is something of note, which is what happens if the budgeted amounts, especially as it relates to the facility, the RDE facility, or the second hotel, or the tenant fit-out, if those costs exceed budgeted amounts. The retail tenants would play a role in terms of the rent that ultimately gets charged to them. The New England Development and Finard will also play a role because they were the ones contributing part of that money up front in order to be able to get it in the form of rent from the retail tenants. And of course, needless to say, all the other parties will play a role because it affects their operations. The ability to deliver a good experience will be based on delivering all the other amenities. Let's go back a little bit. On the next slide, I already spent a little bit of time here, but this is what's the priority of payments and the parties that come together. The revenue at Mohegan, Massachusetts, first there's the gaming revenues. There will be non-gaming revenue and as well as rent from subtenants. The operation would have to pay the capital lease of the equipment, the ground lease, and then, of course, all other operating expenses. There's a statutory capital reserve of 3.5% of gross gaming revenues, after which can only come the senior debt payments. After that, there may be, depending on the revenues, a management fee, as well as those preferred equity payments to Brigade. The management fee would go to Mohegan. And after the preferred equity, there would be gaming incentive fee or the management fees depending on those EBITDA results. After all of that, the parties will be distributed whatever is left in the form of 56% to Brigade as part of being the common equity holders. The tribe or MTGA as part of still retaining that 40% or so ownership. But Suffolk Downs, as the landlord, does get 5.15% of the distributions if there are to be distributed. Yes. If I cannot see that, I know you guys cannot, so I apologize for that. It looked a lot better in the binder. But here's an important slide. The applicant in Mohegan has projected these 857, I'm going to round it up because there's other revenues, $867 million in the base case. Is that year one, Rob, or year three?
Year one.
Year one. I did want to go through this example, which actually reinforces the previous slide, which is after operating expenses, in order to get those revenues, there is the EBITDA, or earnings before everything else. The capital reserve that I highlighted, the debt payments, senior debt payments, you got to pay the bank, then the ground lease, etc. And in a base case, or in a good year, there will be distributions pre-tax to the partners in the form of the percentages that I just described in my previous slide. Now, if one adds the distribution, the ground lease that Suffolk gets with the incentive, with the distribution of minority ownership that they get, and then we also add the management fee and the incentive fee, it's both here, base and incentive, that Mohegan gets, as well as the distribution that Mohegan gets. And if we add separately the preferred equity payment and the distribution for Brigade, all of those numbers come out to be 30% and 30%, I'm sorry, a third of each other. So my assumption, our assumption is that the parties probably came together and agreed in principle to divide the profits three ways, but they structured it in a way to be feasible in terms of the ground lease, the preferred and common equity position, as well as the management and incentive management fee. Now, that's totally legitimate. It's important to note, however, that in an extreme downside case, which I believe is their terminology in the application, the dynamics change considerably. Although the capital, the ground lease is less, you'll remember that the ground lease is tiered. The management and base fee also change because probably the incentive fee diminishes significantly on a downside case. There's a negative that shows up after the preferred equity. So there's one of the parties or all three, or it's unclear how that had an extreme case or a decrease in revenues from, say, 867 to 569 gross gaming revenues per year, who would be required to absorb these loss? This is a negative 5 million. And those are the sort of things that I was alluding to when I was talking about how the term sheet spells out the terms, obviously, but does not necessarily address the events of what happens in the event of a downturn. All of those things get spelled out in the actual agreement. When equity and project financing is a lot more straightforward. First of all, the financing covers all of the project. There's no third-party financing or third-party equity. The project is owned by Wynn Resorts. Wynn Massachusetts is owned by Wynn Resorts, but they own and operate the casino, the hotel, and the food and beverage. They actually outsource 4 of their 10 food and beverage and some of the retail. They do have tenants, but the tenants do not contribute an equity or do not have to bring financing. Their Wynn's financing brings essentially everything. Similarly, their funding plan is a lot simpler. The revenues and the rent that they get from tenants all goes to after operating expenses, and the capital reserve, after paying the debt, can be then distributed to Wynn 100%. So for a lot of those reasons and much else that is are detailed in the report, the Mohegan Sun is a complex structure. It has multiple funding sources. Their stated equity includes a large sunk cost component. In my view, that results in very minor equity if we take out sunk costs or, for example, the licensing fee. I'll speak a lot more in the conditions piece on this number. We believe that approximately 45 million of all the equity contribution would be available to begin the project. We already discussed the notion that the preferred equity really behaves like subordinated debt, subordinated to the bank loan, the 732 million. because that would get seniority. Initially, the applicant did not provide evidence of 155 million of financing, but through the question and answer period, through the request for clarification, they provided the backstop information from Brigade and other unaudited financial information from New England Development and Finard, because they do bring some of that equity to the table. Wind, conversely, is what I would call the plain vanilla, although big, but plain vanilla real estate development. The equity of 600 million, there's a significant amount available after paying the licensing fee, and that is about approximately 33% in terms of actual equity. For those reasons, I rate Wind to be outstanding when it comes to the ability to obtain project capital, and Mohegan is sufficient. I can pause there if you have other questions.
I had two questions, one small, one detail and one thematic. If we go back to slide 14. Which is this chart. Is that the one? Yes. I understood everything except that the ground lease in the middle box on the extreme downside case is 39.9 million. And down below, where it says ground lease and distributions, there's only 31.
Probably a typo. I'll check into it.
We'll have to check into it.
Okay.
Probably a typo, yeah.
All right. The more thematic question is that, if I understand this correctly, Brigade is a money manager, basically.
Yes.
Brigade is investing money for various clients who have given money to it for investment purposes.
Yes.
So this is not Brigade's money that's being invested.
That's right.
It is money of Brigade's clients to whom Brigade owes a fiduciary duty to make sound investments. Is that right?
That's correct.
Okay.
I did want to just introduce the notion here, which is there's a loan to value discussion that I'll introduce, that I'll talk about in page 27. But it relates back to the ability of the applicant to obtain project financing. So as a preview, I may have to come back to this slide after page 27. Other questions, or let's just keep going to the next section? The next section is 1.2. There's the expectations of the applicant is to ensure that other operations do not have a negative impact in the Massachusetts operation. Evidence of strong balance sheet there, and then reasonable levels of existing debt and positive operating results. As I mentioned earlier, there's a lot of information that we're able to glean from what's public and historical public information from both applicants, not just Wynn, who is a public company, but Mohegan as well. Although many cannot really see this slide, it's a slide that we have introduced in the past, the ratios I've talked about. There's a capital asset turnover ratio and liquidity ratio in the form of the current assets and current liabilities, for example. One thing I will highlight here in the interest of time is that Wynn is the strongest among its peers of capital assets over 4 billion. Well, and the other thing is that we are gleaning information from Mohegan, but Mohegan is not necessarily the only entity that brings money to the table. The applicant has made a representation in our in the host community hearing that because of that, because it is a partnership, Mohegan and Brigade, if they were to combine the ratios, they would be a lot more stronger than Mohegan's ratios here. I don't, although I understand that Mohegan is not the only one that brings money to the table here, I don't necessarily agree with that inclusion, the inclusion of all the money that Brigade manages. You simply cannot count other people's money as your own assets when you're determining a current ratio, for example. So the next slide, Brigade was not assessed in this. It really doesn't apply. They are a money manager, as you articulated, Commissioner. They do have proven access to capital. The Mohegan ratios indicate some challenges, especially with the introduction of expanded gaming in New York, but also to some degree Massachusetts, which is almost the same idea here. They are in an increasingly competitive market when it comes to their flagship operation. Wynn, on the other hand, has sound current financial ratios. They do have a concentration of operations in Macau. It is increasingly competitive, but they have demonstrated the ability to compete in those highly competitive markets, Las Vegas and increasingly in Macau. I can pause there as well if you need me to, or?
Well, I would like to just ask you to explain the negative equity for the Wynn piece.
Yes, thank you. I know it's in the report, and I may need help from Rob, but these numbers are as of the last available that we have, which is December 31st. The results of the year ending December 31st of 2013. In that period, there was, you might remember, a cancellation of an equity holder, a large equity holder at Wynn, of those shares, a redemption, I'm sorry. And that has an effect of introducing noise to that ratio. That share was a repurchase, right? No, in addition to that, the dividends, Wynn is not measured because of three things. I mentioned one, the stock redemption of $1.9 billion relating to the cancellation of 20% of shares held by that former Director Okada. There's been a lot of share repurchase to date, totaling about $1.1 billion. So it's something that if the company is not investing in a lot of new operations, for example, they can do and frankly increase their share price. And there's dividends that are declared each year that approximate the net income. So what the company is doing is rewarding its shareholders by virtue of both the dividend that they provide and their share repurchase program that they do. So when you take all those three factors together, including the cancellation of those shares, and there is a lot of public information on that dispute, which is an ongoing dispute between Mr. Okada and Wynn Resorts, it results really in a negative equity ratio number that doesn't really apply, in my opinion. Their operations continue to kick a lot of cash.
So if I understand that correctly, apart from the share repurchase, which is a one-time
Right.
Capital event, they could change this simply by stopping dividend payments and keeping more of the gross gaming revenue in-house.
Not just stopping, they could only slow it down and continue to pay a healthy dividend, but
But in a worst case.
in a worst case, yes,
stop
they
it
could just not.
Yeah.
not
In other
pay.
words, they control this number.
That's right.
Yeah.
They absolutely do.
Okay, thank you.
Okay. Just in the previous slide, I'm sorry. So I did mention Brigade was not assessed, but neither was New England Development and Finard. Michael and Carol did bring up the question, if they were to be in a position of, in the future, of having comps, for example, if they had to be qualified as a qualifier, both the background suitability investigation will be one that we would have to do. The IEB would have to perform, but also the financial suitability of that those two entities would be relevant. We have not done that at this point. So accordingly, the ratios, whatever those are, they're not public companies, so we cannot glean that information. We're not included in this assessment. I summarized this already, right? I'm rating WIN very good and outstanding, given their strong current financial position. I already stated it. Yeah. And then Mohegan sufficient. Section 1.3, we look at the expected returns. Of course, very important in the health of this operation is that the applicant is able to pay back development costs over the term of the license. We look at the EBITDA as presented over the 15-year period, and those EBITDA numbers we discount by 4% and 15% in order to represent a downside scenario. And look at those return on investment. The next slide. In both cases, they do show a positive return on investment that is commensurate with what could be expected in the gaming area or the gaming industry, even with a significant discount rate of 15%. But I will mention this because it's going to be relevant a little bit later. The calculation that we do in this section is limited to the EBITDA as presented by the applicant and applying those discount rates. The actual test for the reasonableness of the revenues is going to be discussed in the market assessment. In other words, how we feel about the initial number of that EBITDA, in other words, the starting point, the revenues, we compare against our own market assessment, and how we feel about the reasonableness of the cost, the big number that comes after the revenues, is going to be tested in the operations plan. So if we simply take the numbers as presented, both applicants show a positive return on investment, which is good. However, we're gonna talk a little bit more about how comfortable we are about the applicants reaching or achieving those numbers or those returns, given what they've assumed in terms of revenues and cost. So, in light of that, both applicants are rated very good. They both achieve a commercially reasonable return on investment, even applying a high discount rate. Okay, let's move on to the investment plan. You'll remember our own regulations relative to the capital that they're required to invest in the property, a minimum of $500 million, excluding certain costs, some of which can be significant. We do talk a little bit briefly in this section relative to the timing of the total development. And we also analyze the consistency between what they propose, the quality of the facility that they propose, and what the market or expected market penetration is. Next slide. And luckily, I have a second slide with numbers that are a little bit easier to read than that. But there's three numbers that I'm going to recite from here. These are the comparison that I was talking about. Springfield MGM is in the first column. Mohegan is in the second, and Wynn is in the third. The portion at the top of this chart are all eligible costs. Commissioner McHugh was talking a little bit about those construction costs. The number for Mohegan Sun is $376 million in terms of hard costs, compared to $957 million in Wynn. It's important to note that MGM has higher costs in terms of hard costs at $408 million for a region that has a lot less in projected revenues. I highlighted those numbers because the way you get to the actual minimum threshold is after we include gaming equipment, which in this case is a significant cost. And there's a little bit differential between the applicants because Mohegan proposes many more machines. So once we add the gaming equipment and other FF&E, the Mohegan applicants' total project costs for construction, total eligible, I should note, project costs are $526 million. That's the 527 figure that you were describing earlier, Commissioner. MGM is 515, and Wynn is more than $1.047 billion. I'm going to speak a little bit more about those numbers in the next slide. I'll just mention a few of the ineligible costs. Here, there's important differences between these. The applicant predicts, Mohegan predicts that they will spend about $181 million in financing, and that is only during the construction period. Those are the costs that we have otherwise termed as capitalized interest, which is almost double of what Wynn is projecting with a twice big operation. Land purchase is a significant cost that's not included. For Wynn, it's an ineligible cost. But similarly, the rent, the ground lease during the construction period is a cost that has to be reflected in Mohegan. I mentioned before that there's a very large difference between pre-development costs. The applicant in Revere arrives with $105 million spent to date, whereas Wynn has spent $21 million to get here. I'll just mention one point here, the contingencies. The contingency as shown initially for Mohegan is $44 million, and the contingency for Wynn is $55 million. Since December 31st, when these budgets were submitted, there's been some additional surrounding community activity or inactivity. And some of these numbers, some of the numbers, at least for Mohegan, have increased slightly, but we asked the question, and we believe that is adequate, that it comes from the contingency number. Sure. Let's just go to the next slide, if you could, please, Melissa. Here's where I was going to talk about loan to value. These are the numbers that I was just talking about, 376 in hard costs. This is the number I would use if I was to divide by all the rooms, compared to 957 million for Win, because I wouldn't include the gaming equipment. Actually, I would probably add the 376 and the other FF&E. Actually, I did, to come up with 424 million. 376 and 48 is 424 million that the applicant proposes to spend on actual improvements. This is a number that the bank is going to look at, because they are projecting, or they are, they're projecting that they will borrow 732 million from the bank. Conversely, well, let me just follow Mohegan on that train of thought. I didn't calculate it here, but I want to speak to 424 million. The addition of 376 and 48 is the real property and improvements of the project. Mohegan MSM proposes to borrow $732 million, and that is a loan to value of 1.72. That's a high number, in my opinion. It may be, they may be able to do it, but I'll speak to why that is a bit of a concern in a few minutes when I get to some of the other slides. The loan to value in Win is very different. If I take the 957 million that they propose to spend on the site and were to include the land, because they do own the land and will own all the improvements and remediation, they are north of 1.1 billion of money that the bank could go after if their loan is not repaid. Their loan is 982 million, and if you have improvements that exceed the loan, that gives the bank a lot more comfort that if everything goes bad, if something goes really bad, there is a lot of assets that they can go recover or try to sell or whatever may be the case. That is the case with the loan-to-value ratio. That's really what the loan-to-value ratio tells us. In the case of Win, the ratio is below 1, which is where we want to be at 0.87. Are there any questions on this slide?
Yeah, I have a question.
Yes.
Obviously, the higher rate of spending is of benefit to the Commonwealth. How do you characterize that, though? How do you value that? The difference in the two rates of spending, say, construction alone, there's a big difference.
Yeah, well, a lot of these, I'm looking forward to the discussion tomorrow. To state the obvious, construction jobs, if you believe like me that construction jobs are directly generated from actual spending, then there ought to be a lot more jobs here than here. There's significant spending on the Mohegan side, but a lot of it goes back to pay interest, goes back to pay for what the customer may not necessarily see. There's a lot that they will be able to see, but there's numbers that here that start to have a lot of bearing into the other sections. Yeah, well, that's true, obvious. The other, maybe you were alluding to this directly, but the other one is obvious to the quality of the building. If you may have a drawing, but it needs to be backed up with the dollars. Now they have proposed different square footages per room, for example. They have a different site. I should note, however, that the number here does not include site remediation. That number is below in the ineligible piece. It is actually eligible the way we defined it in our regulations. The applicant just collapsed it with their land number. But fundamentally, just staying here, it goes back to the quality and the ability and the margins that they may have in the numbers that they have budgeted.
Thank you.
Quickly on that, slide 26, because just for everybody's clarification at home, under other costs on land, you have 75 million attributed to the Everett Wind project, and put the asterisk next to it, and there's kind of an incomplete note where you talk about 45 million in other land-related.
Other land-related costs, and these are just what I was talking about. We believe there's some remediation that takes place out of these initial costs. Now, correct me if I'm wrong, Rob, but when we made the determination about the reduction in the price of the land after December 31st or before December, it was before December 31st, right? So yeah, they probably kept the same number and decided to aggregate whatever additional costs would come from the actual remediation. This is not just the actual land purchase.
Okay.
30 million is land purchase, 45 is the remediation
Okay.
from that.
And under other FF&E, under the just below gaming equipment, why is there a higher spend projected than when?
On other FF&E, this may be just the way that they decided to aggregate the costs. It's just, fit out. Somebody may count them as part of, the contract that you give the general contractor or a separate contractor for the actual finishes. But the other FF&E I would include in the construction. We actually do as matter of our regulations. They count as eligible costs. The way I want to differentiate, however, is that there's a big chunk of gaming equipment. They both have to purchase, one leases the equipment, the other one purchases, but it's a different amount of slot machines, which is an important difference there.
I'm not sure whether I'm missing something or not. The bank financing we've established is 732 million in this projection. If we look at this slide, building hotel, a piece of that is going to be paid for by the third party, right? 60 million of that 115 million is coming from a third party.
Which number?
Of the building hotel.
What is it, 150?
I'm looking at
115. What? 115.
115. 60 of the 115 is coming
Yes.
from New England Development Fenard, right?
Yes.
Okay.
Well, actually, no. Let me say this. My guess is that because there are there's architectural and engineering costs, as well as other project costs that are broken out separately that should be attributable to the hotel, to the third-party hotel.
Okay, but in an earlier slide, we looked at a contribution toward the boutique hotel
Yes.
of $60 million by New England
Yes.
Properties Fenard, right?
Yep.
So $60 million of the 1.131 is coming from.
No, I don't think so. But we should clarify this.
Okay,
$60 million of the 115 plus 20 plus 7 plus 2, and perhaps even plus 76, the parking garage. Would the third-party hotel utilize and be required to pay for the parking garage? I would think so. So there would be a cost determination. The problem here that you may be highlighting, Commissioner, is that they did not break out for each of the building components. They did not break down those costs per building component.
Okay,
They've
so
been
let-
aggregated.
Okay, so let me get at my question a different way then. If we look at the FF&E of $150 million,
Put the next slide, Melissa, please.
that's this one.
Well, it's also
Okay,
highlighted here.
maybe that's easier to see, right.
Yep.
150 million, 151 million of the FF&E is, some of that is a capital lease, right?
Correct.
102.
So it's going to be paid for out of operating expenses,
Correct.
operating revenues, right?
75 is
Okay.
capital lease.
Yes.
My bottom line question is, what is the 732 going toward?
Yeah.
You've got 526 of construction costs, some of which is not cash costs. It's an investment over time. So the actual cash cost is less than 526, right?
Yep.
Thousand. And when you get to other costs, a lot of those costs down below are soft costs. They're operating costs of one kind or another.
Well, no, some of the 732, and I will speak to this in more detail or in some
Okay,
detail.
then I'll wait.
But it's let me mention this. Some of the 732 million has to pay for a lot of what promises they have made elsewhere. Host community, surrounding community, all of those payments are due right after award of the license. They will become conditions of the license. And for them to be able to operate, one would presume that they would have to make those payments. Now, you may be thinking of, from the bank's perspective, which I will speak to later. If you have a high loan to value, and you see that some of the costs that you are lending are not necessarily going to pay for things that you want to go after, the ability to obtain that project capital becomes questionable.
Well, that is what, I'll wait for you to develop that thesis, but it was the loan-to-value ratio that triggered my inquiry, because I'm not sure I fully understand the 732. I mean, I understand what you're saying, but I...
Yep. Hold that thought, and
All right.
we'll have an additional discussion
All right.
like this. Now, where were we before we came back to this slide, Melissa?
Slide 28.
28? Okay. Let's go to slide 28. It looks like I already spoke about this, but I haven't. When it comes to the actual investment amount, we almost get 2 casinos in the Wynn proposal. There's a lot of cost in addition to that, but we've determined that as per our regulations, that they don't count in terms of the eligibility for capital investment. Conversely, Mohegan just meets the minimum requirement. And worthy of note is that approximately 357 million are costs that are spent on financing the rent during the construction period and the monies to spent to pursue a casino license. And all of that is something that the customer doesn't see. Would it be time to take a break or
Sure. Would you
continue?
like to take a break? Should we take a 10-minute break, and then we'll
Let's take a
resume?
10-minute
So
break before we go in the next one.
it's now 5 minutes to 3. We'll shoot for 5 after 3. Ready, Commissioner?
Yep, I think we're ready, and we might be on, Rob?
Microphones are on. All right. Let's resume.
Okay, just keeping with what we've done in the past, we also looked at the project timelines from a reasonability perspective. because it does have some bearing into the amount of time that it takes to recover the investment that you have to make up front, not necessarily on the how or whether the activities and the sequencing of activities is reasonable. We did review the plan timelines. We did not necessarily spend a lot of time in the necessary permitting. Just to recapitulate some of what Commissioner McHugh was highlighting this morning, the applicant proposes a completion time in the case of Mohegan of approximately 30 months. WIN proposes 36 months from the start of construction. In my opinion, both applicants provide a reasonable timeline for opening the facility, given the size and scope or complexity of the development and the site location. While Mohegan would seemingly have a 6-month advantage, if you will, as you have seen from my previous comment, the ability to obtain financing and the complexity in terms of the parties and how they come together, at least in my mind, had some bearing into offsetting a little bit of that advantage. Either way, I recognize that these are very complex, very multi-factorial projects, and we believe they're both very good when it comes to timeline. The next section that we looked at was relative to the consistency between the size and the scope of the facility and how that ties into the operations plan, their marketing plan, and later you'll see in the financials that they provided. I'll recapitulate a little bit of what we've talked about before. More slots in the case of Mohegan, more tables in the case of WIN. Slightly more gaming floor in WIN. There's a boutique hotel and a casino hotel difference. When it comes to WIN, they propose a 5-star hotel. The food and beverage seat is higher with the same number of operations. When it comes to Mohegan, same number of food and beverage, although WIN, unlike Mohegan, owns 6 of their own facilities, of their own outlets. There is equivalent space when it comes to multi-purpose, more space when it comes to parking over at Mohegan, exhibition space that's slightly higher with Mohegan, and same with retail. I want to highlight the total gaming square footage. We have a calculation, Rob, remind me, to come up with what would be excess space, the proposed minus what's required. Remind me the ratio for
30 square feet.
30 square feet right here. 30 square feet per slot machine and 300 square feet for table. The comparison here is that there's slightly more excess space with WIN, 44,000 versus excess space in Revere, in Mohegan. In our view, this is relevant because one WIN may be able to react to conditions in the local market or international market with a lot more flexibility. They might be able to add more machines, repurpose some of the space, add tables, decrease machines, do the opposite, etc. Whereas this may be a little less flexible, but doable, of course. There's only a slight difference. The parking space is relevant as it turns to the parking position. So while Mohegan has more parking spaces, they do have more parking positions, and the ratio ends up being a little bit comparable. Just staying there for a minute, Melissa. The proposed food and beverage seats per position are also reasonable given the projected visitor volumes. So as a result, in our opinion, both applicants, although they are targeting different demographics, they are doing it with different product, more slots in one case, 4 starts in one case. There is consistency between what they present in the drawings, what they present in their financials, and what they present in their operations plan. I will note there is a difference again that Wynn has relative to pre-opening expenses. They project 61 million in order to draw customers from here. This is in the form of advertising, but also importantly training. Rob, if I'm not mistaken,
Yeah,
is
big
training.
chunk of his labor.
Yeah, a big part of this is labor. Mohegan has 10 million allocated for those expenses, although they do have recognition in the market here in New England. I'm going to turn it over to on the next slide to Rob from HLT. He helped us do the market assessment. I'll let him do that, and I will come back to the end of this section on the rating.
Thank you, Commissioner.
Thank you.
If I can do a little bit of a summary, the last time we spoke about market assessment was back under the Category 2s, and a lot of time has passed, and we never spent a lot of time at MGM. Given the significance of the Region A location to the Commonwealth's overall gaming objectives, we thought we'd walk through some of the concepts and the background of the market assessment and how we use that to evaluate the bids in this section. So the first thing I'd like to mention is that the market assessment just provides a framework, and it provided a framework that allowed the commission to assess all the different applications by the Category 2 and the Category 1 gaming license. Every individual gaming operator will have a different interpretation of the market opportunity. We'll call that in this section a view of the market or market view. So each applicant was free to choose how they'd look at the opportunity. The market assessment that we performed allows a common framework to assess everyone's view of that. Key considerations of the assessment is size of the expected market as measured by gross gaming revenue. Also individual facilities gaming revenue projections and market shares. Gaming revenues are simply a function of the size of the gaming market and competition, and the size of gaming markets is a function of the adult population and their propensity to game and gaming supply in that market. Key elements of the market assessment include the geographic extent of the total market area, total gaming dollars available, and market shares after in-state competition. Drive it here. Just to recap, in terms of competition, the proposed Category 1 facilities, and it applies to both regions A and B, are similar in size and scope relative to existing competitors. 3 of 4 existing competitors, that being Rhode Island and Connecticut, contain between 4,500 and 6,300 slot machines, offer table games, and have a variety of ancillary facilities. The Category 1 facilities are proposed to offer between 3,000 and 4,000 slot machines and between 100 and 150 table games. The Category 1 facilities will operate in an environment similar to existing competitors. I'll discount Rhode Island at this stage in terms of tax rates on slot machines. However, unlike existing competitors, Category 1 facilities will not allow smoking. So smoking will be permitted at the Rhode Island facilities, is today and will be tomorrow, and the same thing at the 2 Connecticut facilities. Also, there's no table tax in Connecticut and an 18% table tax in Rhode Island. Whoop. There we go. So just to reiterate, the size of the market, we determined the size of the defined gaming market as roughly did a drive time analysis of the existing facilities. And what we determined for the purposes of this work and the evaluation, that we would consider all of Massachusetts, all of Connecticut, all of Rhode Island, and the southern portion of New Hampshire as the, if you want to call it, primary area for Massachusetts facilities. At the same time, though, we realized that a facility within that area also would have the ability to generate visitation and win, or revenue, from areas beyond. Now, since we started way back last fall, so actually almost been a year, a few developments have occurred and are still occurring within the environment that surrounds this defined market area. And on this map, on the yellow on the left-hand side, is since last fall, New York, the state of New York has moved forward with an RFP process to award up to 4 casinos in 3 regions in the state. You'll see the Catskill Hudson Valley region, and then the Capital region. There's a 3rd region just to the west of that. If you notice down on the bottom, you'll see zone number 1, New York. That's another region. Once they award facilities over the next few months in the 3 identified regions, 6 years after that point in time, they'll reconsider licenses, additional licenses for zone number 1 in New York City. Now, just as a, okay. Within the past year, New Hampshire again has looked at introducing casinos and has defeated that. That will probably continue to be a hot topic over the number of years, especially when we look at awarding licenses in Massachusetts for 15 years. It will definitely be looked at again over the next 15 years. And last week, the state of Maine released a report that stated that an additional casino located in southern Maine could be viable in the marketplace. So at the end of the day, what we're talking about is the state recognized a long time ago and still recognizes today that Massachusetts is in a competitive regional gaming market. And just to give you some numbers, if we take a look at the 2 properties in Connecticut, the 2 properties in Rhode Island, if you notice on New York, there is 4 existing Racino operations in eastern New York. There's 2 Racinos right here in the red dots, and there's also 2 down in New York, closer to New York City down there. In total, all those properties generate about $3.8 billion in 2013. And to give you a sense of what has been going on in this marketplace over the past number of years, since 2007, the 2 Connecticut properties, Mohegan Sun and Foxwoods down here, they had generated gross gaming revenue of $2.5 billion in 2007. They're down to about 1.7 right now, so the loss of about $800 million combined. Rhode Island, in 2007, the 2 facilities there generated about $425 million. They're actually up to $550 million. Part of the reason why they're up is they added table games over that time period. And if we look at the New York racetracks on the western edge, so these 2 small ones here, they were around $200 million in 2007. Now they're up to $225 million. Now the 2 racetracks on the bottom here were implemented since 2007. So actually in 2007, those 2 tracks down here generated $350 million, and today they generate $1.3 billion. So part of the reason why the 2 Connecticut properties are down $800 million is these two properties have entered the marketplace. So after we defined the market area, the next step we did was we took that larger area and broke it down into sub-market areas. These sub-market areas are based on zip codes. Now, we had to do this prior to understanding how all the different applicants divided up the market from their perspective. So some applicants divided markets based on drive time, some applicants divided markets based on county boundaries and such. So you don't get a complete apples-to-apples comparison when you look at the various studies. But we're allowed to, we can aggregate this and we can make some estimates. One of the reasons why we had to break down this larger area into smaller areas is to facilitate the market share exercise that we went through. This is touchy. Where have you pointed at here? There we go. Actually, Melissa, I'll let you take over because I'm, okay. One of the first steps that we undertake in this exercise is to determine the total dollars available. In this chart, it's a simple calculation. It's adult population times a adult or a win or revenue per adult basis, and we establish those $300 and $350 benchmarks based on comparison markets in the Northeast, including up to Pennsylvania, Pittsburgh, also Philadelphia. We also looked at past reports done for the state of Massachusetts and looked at where they were coming in at in terms of available market. So in total, we're looking at $2.6 billion to just over $3 billion available. Part of that market, though, is already captured by existing facilities located within our defined market area, that being Connecticut and the two facilities in Rhode Island. And some of this market is also being captured by facilities located outside the area. So the next step after determining sort of where the dollars are located in our market area, the next step is by region, we assign market shares. So all this map shows you is for the Region A location, and we assumed a central location in Boston for this purpose, is this just shows you the market shares that a facility located in Region A, what we think could reasonably expect given the amount of competition already existing in the marketplace, plus the in-state competition coming in, that being a Region B location and a Region C location, and a slotted racetrack facility in Plainville from there. And please don't, in terms of the squiggly lines, those are just drive times, and that's only there for illustrative purposes, just to give you a sense of distance. Essentially, the green squiggly line, 30 minutes. We took those submarket areas that generally fall within that and color-coded them green. We also took the up to 60-minute, the red squiggly line, took the areas between the 30 and 60, colored them an off orange, just for illustrative purposes. And again, from the 60 to 90 minutes, we colored blue from that perspective. Generally speaking, as you move farther away, you will get less market shares because you start coming into where competition is located from that perspective. And as you move farther away, you'll still get some business, but you'll end up being smaller market shares because the closer facility will get a larger market share. Now, one of the things that we should bring up at this stage, at this point in time, is when the market assessment was done, it was done on the basis of not fully understanding all the applicants' submissions from that. So, in general, the market assessment was done off of theory. That theory being, if two facilities are the exact same, people will travel to the closest facility. If one facility is materially larger than another facility, and that largeness or the extent of it being bigger can be of an actual physical size, could also mean the number of gaming devices, can also mean the number and level of quality of amenities. So if a facility is larger in terms of size, scope, and quality to another facility. The facility that's larger should have the ability to generate visitation from farther away from the marketplace. If every facility that was entering the market was the exact same, and everyone, say, it was operated by the same person, and they were all operated the exact same, had the same number of machines, same number of amenities, people will gravitate to the closest facility from that perspective. And that's really the theory behind the gravity principles. Next one. Those market shares that you saw on the map just translate into dollar amounts. And so essentially, the base amount of dollars available for a Region A casino, we're projecting at somewhere between $700 and $822 million. Now, in addition to that, we also state in numerous sections, which we'll talk about a bit further on, is this concept of inflow. And inflow actually was factored into the original state's market assessment that was done by Spectrum Gaming. It actually was factored into the decision that the state came up with in terms of determining its casino model, in terms of we want casinos that are able to compete with the regional environment, and we want to draw visitation and business from farther away. And we'll talk about that in a little while. What's that? Next one. Now, you'll notice in the background sections, HLT does not provide any inflow numbers. That said, we do look at existing facilities in the marketplace. We do look at, based on our experience in other jurisdictions in North America, what we think would be reasonable for a facility of a Region A location would be somewhere between 10 to 20% of additional revenues above and beyond the defined market area as an appropriate level or amount of inflow available to a Region A location. Now, in order to assess the applicant's market viewpoints or how they're going to approach the market, well, the first step we did in this exercise was look at the actual dollar amounts. So in this slide here, on the top we have Mohegan Sun, Massachusetts. They're projecting revenue starting in year one of about $800 million. And they expect by year three that to grow to $910 million. On the bar charts, you will see a blue portion and a red portion. That blue portion is really the slot machine revenue, and the red portion is the table revenue. Wynn Everett on the bottom, starting off at $804 million, very similar. And by year three, growing that to $845. They later revised their year one numbers to 832, so slightly higher than the 804. The main difference between the two applicants is the amount of red and amount of blue in each of the bar charts. And as Commissioner Zuniga pointed out earlier, Wynn is more focused on the table business, and Mohegan is more focused on the slot business. Now, each applicant approached their market assessment through use of a third-party consultant a little bit differently. So let me take a little bit to explain how each of the applicants' third-party advisors approached the marketplace. What this slide shows you is the market area defined by Mohegan Sun's third-party assessor, and we superimpose that on the defined area of HLT. So essentially, how Mohegan Sun, Massachusetts defined this is they define two zones, a primary zone and then a secondary zone. They define those two zones first based off a drive time, 30 minutes for the primary zone, approximately 60 minutes for the secondary zone. In reality, those two drive times were just used as a proxy. What they ended up with is they used boundaries of counties to define those two zones. So in terms of the primary zone for Mohegan Sun, the primary zone consists of Suffolk, Norfolk, Essex, and Middlesex County, and those are highlighted in green. on this map. In the secondary zone included Plymouth and Bristol in southeast Massachusetts, and Worcester in central Massachusetts, and 3 counties in southern New Hampshire. And again, though they're highlighted in that orangish red color there. The rest of the market, so that being all of Rhode Island, all of Connecticut, and all of western Massachusetts, their advisor said that business from those areas would be included with the visitor section, or the visitor category. So the first step we did, Melissa, is took those areas and we compared those areas to HLT's defined market areas, but we used these specific sort of sub-areas based off of Mohegan Sun. So essentially, it's not a direct comparison, but it gives you a magnitude. So if I read across, or if you look at the primary zone, Melissa, can you flip back one? Now remember, the primary zone are the 4 counties that surrounding the Boston urban area. The applicant believes that he'll be able to penetrate in year 3 that market area approximately $670 million. Through HLT's market assessment, we believe a Region A location should be able to generate anywhere between 480 and 560 million from that same area. So the applicant, as compared to HLT's numbers, are aggressive in terms of that primary market area. If we move down to the secondary market area, break out Massachusetts from New Hampshire. In Massachusetts, HLT believes, and through its estimates, that somewhere between $60 to $72 million is available for a Region A location. The applicant believes it could penetrate that area approximately $50 million, so a little below, slightly below. And in terms of New Hampshire, the applicant believes that it can penetrate approximately $150 million from New Hampshire, which is slightly higher than what HLT believes, is somewhere around 96 to 112 million. Now, the outside PKF market area line item there really includes all of Rhode Island, all of Connecticut, and all of western Massachusetts. We believe that a Region A casino would be able to penetrate those market areas and generate revenue of approximately $65 to $75 million. And the applicant, through its third-party market assessment, does not believe it'd be able to sustain any meaningful revenues from those areas. That said, they did provide a number of $40 million for visitor casino win, and that number was calculated based off of the hotel rooms that'll be on site, approximately 500, plus the local area hotel. Part of that $40 million likely would originate from Western Mass, Connecticut, and Rhode Island from that perspective. So in total, if we just look at from the market area, what we're talking about here is the applicant believes it can do about 870 million, and HLT believes somewhere between 700 and 825 million. Melissa? Now, one of the tests we did, because that view of the market in terms of the extent of the market area, we thought was much more narrow. It's not consistent with other larger regional resort casinos that in the Eastern Seaboard that we've had experience with. So we did a couple tests with this one. This map just breaks down that $900 million where it's being generated from. So we summarized it in the previous chart. So essentially from the primary zone, 668 million, from the Massachusetts portion of the secondary zone, 51 million, and from the New Hampshire zone, 150 million. All other areas, 40 million. So the one test we did, because in this market area, we have prime example of 2 large regional resort casinos, that being Mohegan Sun, Connecticut, and Foxwoods, available in this marketplace. That gives us an indication of what a properly positioned casino in this part of United States could possibly generate. from there. So essentially, look at the experience of the two Connecticut properties, and then if we move one of those facilities to Boston, what could it do? So the next slide, the first step we did is we took the same principles that were applied to determine the Boston market area, and we applied those to the Mohegan Sun, Connecticut location. So the green portion on the bottom would approximate the 30-minute drive time that was applied to Boston, and the orange in central Connecticut and in Rhode Island would be the secondary, and both those two market areas overlap in Worcester County in the central part of Massachusetts. Next one. Then what we did, based off of UMass Casino Visitor study in 2010, or 2013 update that was contained in the Mohegan Sun, Massachusetts third-party market assessment report. Also based on clarification questions to the applicant on sources or where they currently generate business from, we were able to estimate the current breakdown of year-end 2013, $862 million from Mohegan Sun, where it's generally located. So this map shows you for the Connecticut property where it generally generates business from. So approximately half a billion dollars is generated from the state of Connecticut. 26 million is generated from the state of Rhode Island. In total, 154 million is generated from the state of Massachusetts. 4 million Maine, 3.5 million Vermont, 18 million New Hampshire, and 118 million New York. So essentially, if you look at sort of the market area where all that's done, that's a lot larger market area than the one that was defined for the Boston facility. Quite substantially larger than that one. And if we applied the same distances to Massachusetts, it's even broader or larger than what HLT defined as a reasonable market area for the Commonwealth to assess casino licenses from there. Now, in addition to those areas where they generate business, an additional $30 million is generated from beyond New York and beyond New England area. So from that perspective. That is stands in contrast to the projections that a Region A location in Boston, or the applicant put forward for a Region A location in Boston. We applied the same exercise to the wind application. This map shows you WIN's third-party market assessor, how far they believed that the WIN's Boston or Boston area casino could generate business from. And essentially, they project that a properly sized facility in the Boston urban area of a sufficient quality should be able to generate visitation from within 200 miles of Boston. That would put us into, well into New York, including all of the New England states, Maine and Vermont, and pretty much all of New Hampshire into there. On this map, we superimposed HLT's defined market area, which was all of Massachusetts, Connecticut, Rhode Island, and southern part of New Hampshire. The next step we did with WIN was took his market areas and compared them to HLT's. And essentially here, he defined his market areas based off of distance zones based off of travel times. So if we look at his market areas within 30 minutes, he's projecting that they can generate somewhere around $375 million, where HLT believes the available market there is somewhere between 425 and 500 million. Between his 30 to 60 minute drive, he's projecting approximately 125 million. HLT believes there's somewhere between 150 and 175 million. 60 to 90 minutes, 75 million, compared to somewhere between 85 and 100 million. And market areas beyond 90 minutes, WIN is projecting 40 million. HLT believes somewhere between 50 and 60 million available. But in addition to, so in total from the market area, Wynn is projecting that he can generate somewhere around $615 million from the market area. HLT believes there's somewhere between 700 and 825 available. So essentially, he's lower than, a lot lower than what HLT's view of the market. And if you compare that to the Mohegan application, they're a lot higher than. In addition to revenue from the defined market area, Wynn believes that he can generate an additional $56 million from the New York area, from Vermont, from northern New Hampshire, from Maine, as a drive-in business to his property. He also believes that he can generate $75 million from high-yield or high-end international gamblers that he'd be able to attract to the property. This component of his market assessment we could not test based off of examples in North America. For this one, we had to look at the infrastructure available to be able to reasonably test if that number was a good number. So essentially what we did is we looked at how many marketing reps the Wynn organization has, where they're located in the world. We also look at their experience from their Las Vegas operation relative to ability to bring in high-end players from around the world to that property in Las Vegas. From those assessments, we were satisfied that that $75 million is a doable number. It's a reasonable number. Now, in addition to those segments, Wynn also projects that he could generate approximately an additional $100 million based off of the existing tourism flow that comes through the Boston urban area and Massachusetts in general. So people staying at area hotels, people visiting family and friends in the area. So he's, in this sense, he's leveraging off of the existing visitation to Boston. He believes that he can bring in new visitors to Boston, gives another reason to come to Boston, and he believes that he can generate another $100 million from that marketplace. So if we added up his sort of market, his revenue projections from beyond the defined market area and excluded the international gambler business, essentially he represented about 18% of his total win would come from inflow. We believe that's reasonable. It's within the 10 to 20% benchmark that we established, albeit it's at the high end. He's demonstrated it, and albeit in a totally different gaming market, but he's demonstrated he had the ability in Las Vegas to bring people in from farther away from there. The next slide, Melissa. So if we take his revenue projections and apply it on a map similar to what we did to the first applicant, what we have is the $375 million is from the green area, $124 million is from that orangish area, that's 30 to 60 minute drive roughly, $77 million from that blue area, gets us over to Worcester area, $40 million from Connecticut and Western Mass, and outside the HLT market area, so New York City, Vermont, Maine, northern New Hampshire, another $56 million, and then all other areas approximately just under $100 million from the tourism inflow. I'm going to turn it back to Commissioner Zuniga.
Thank you, Rob. So as Rob was detailing, and let me mention something that I think it took me a little while to appreciate. What Rob refers to as the applicant's view of the market, I believe is really their market strategy, how they're going to their go-to-market strategy, how they're going to the market, their understanding of what's available. What are they going to go for? And even though these this terminology hit me after everything was printed. I really think that the way we should be referring to when it comes to, when we talk about market view, is really the market strategy. Different from marketing strategy, this is how they see an opportunity, who they're going after, where do they have experience attracting that customer from. I'm just going to wrap up the market assessment on the next slide, and talk a little bit about our view that Mohegan Sun's market strategy is insufficient. We don't believe that it is consistent to what they are able to do in their own operation in Connecticut. From Connecticut, they're able to attract from a wide market area. In this case, they are telling us that they're not able to penetrate Connecticut, Rhode Island, and Massachusetts on a city that has a lot more assets to offer in terms of amenities in the very vicinity. Their market view, as I mentioned, is not market view or market strategy is not consistent with what they can do elsewhere. Conversely, wind is lower than what HLT predicts in terms of the market area, the immediate market area, but is really going for actual visitation from outside the region. In our view, attempting or going for and having had the experience attracting high-end players from outside the market area is something that they've done, and it's something that aligns with the model that I was talking about earlier in terms of revenues from out of state. I can pause there if there's any questions.
I have a couple questions,
Yep.
Commissioner. So we're rating them on Mohegan Sun on what they tell us, not necessarily what HLT believes is accurate. In other words, limited ability to attract visitation from outside the region. That's what they're telling us. Is that accurate?
Well, yes, that's what they're telling us, and they're telling us not just in the market study that they've done. This is where a lot of the some of the ratings start to have interrelation with. So some of the topics start to have interrelation with others. The higher emphasis on slot play is generally, but not exclusively, reminiscent of more of a local, more of a closer facility. The 4-star and 3-star topic, the Dave & Buster's, the choice or feel that they are proposing to have in the facility would be more consistent with visits from closer. There's also the marketing restriction that has a play here that I already talked about. If they believe that the market area is that primary zone that was in the previous map, maybe we can flip back to that, Melissa. That's what they felt needed to be restricted relative to protecting this operation. That begins to then work in tandem towards what we refer to as their market strategy or view of the market opportunity.
Okay, so you said you were going to explain this. This is where, correct? This marketing.
Market.
Yes, the market assessment, meaning the zip code piece.
Right.
I'd like to understand that better.
Yes.
So I understand that the ability to market up to the same level, correct? Is that,
yes.
You alluded to, you mentioned that
That's
earlier. Right. So what you're saying by that is that's a disincentive for, well, I don't want to, why don't you, could you please
Yes.
give me a little more information with regard to the zip codes, the marketing up to the same level, and how
Right.
we see that affecting this?
Right. So the market restriction, Robert, just correct me if I'm wrong, applies to everything that is green here?
Approximately.
Approximately. Okay, sorry. Yeah, because it's by zip code, and this is by county. They generally align, but it's limited to the green, or it's limited to the green. So when Mohegan, Massachusetts opens, or prior to its opening, what the applicant proposes is that they will seed, this is a term of theirs, they will transfer a database of the customers in the region to Mohegan, Massachusetts. After that point, the properties will be operated separately, but there will be a third party looking at whether the properties, all other properties in Mohegan, for Mohegan, but really the one that is of greater consequence is the one in Connecticut, is not going to market to in excess of what Mohegan, Massachusetts does to the people that live around this area. That is the restriction. Now, what that tells us is that the focus of this facility is going to be in this, in this region. It also, tells us that there's other data that tells us that, which are their own projections, which Rob just went through. Now, Connecticut can match whatever Mohegan does, but there's a lot of questions that come up shortly after. How do you define a marketing dollar? There, is it free play? Is it equivalent? How do you price a stay, a room stay? It's not the actual advertised rate. There's usually an internal rate by which they account for hotel stays. So somebody in this area could be receiving different offers from the closest facility or the slightly further away facility. They could be equivalent, and we don't know exactly how they would be determined to be equivalent. So we had a number of questions, by the way, on the applicant on this topic. They responded ultimately that the third party would establish standards and procedures to answer all those questions that we have. How do you value free play? How do you value a room stay? Now, there's also the notion, this is direct marketing. There's also questions that come to my mind when it comes to reverse inquiry. What if there's an existing customer here that has a host relationship with an operation here, with the operation there in Connecticut, and asks for, I don't know, free tickets to the next concert? Would that apply? Would that host then have to go into the database and verify whether there's marketing dollars that would already exceed or is below that threshold? So there's a lot of questions that came as a result of that. At a first level or a first plane here, the fact that they're valuing these as the area worthy of quote unquote protecting, in addition to the financials, in addition to the market assessment that they performed, tells us that that's really going to be their area of focus. What we're saying, however, is that a casino in Boston for that region could and should generate visitation from much further away. Yes. That's right. It's illustrated here. this is actually what they have, what Mohegan does for the Connecticut operation. Is that correct, Rob?
Correct.
They're able to draw from a wide, from basically all of New England. Now, there's also something that I think I should mention relative to the suburban-urban notion that has sometimes has been in the parlance before. A suburban casino, by that definition, needs to attract players from far away. There's not a lot of people around them. An urban casino can attract from nearby, but that doesn't negate that they should be able to also attract from further away, which when we compare to what Wynn has done in their own market assessment, market projection, their market strategy, it is a lot more consistent with the notion that a Boston casino should be able to attract both from here and from far away. It's a destination city. It's nearby airport. There's a lot of amenities that can complement an experience, and that's why we view their rating to be very good.
Also, Commissioner Cameron, in the state's original market assessment study by Spectrum Gaming, they actually did two scenarios. The first scenario they did is they assumed that all three casino license, or all three casinos located in the three identified regions were roughly about the same size and quality. The second scenario they did is they assumed if the Boston area, Region A area facility was much larger than the other two regions, what type of projections that it could do. And under that scenario, it projected that of the three regions identified in the state, the Region A had the best ability to get business from a lot farther away than the other two regions. So it was acknowledged when the state created its model, as you say, or if we want to call it that, and how the state viewed the opportunity. So if there was going to be one region that could generate business from farther away, it'd be Region A as opposed to the other two regions.
So is Mohegan Sun underestimating their ability to draw from a larger market, or are the restrictions you talked about detrimental to doing that?
Underestimating or not viewing the opportunity? I don't know which one that is.
Underestimating or what?
Or just not viewing the opportunity,
Not
not
viewing.
acknowledging the opportunity.
Not acknowledging the opportunity. Okay. Thank you.
I have some questions along the same line, and let me just pick up on that thread. The HLT analysis says that at $350 per adult within the various regions, the market will yield $822 million. Right?
Up to, yeah.
Pardon me?
That's the higher end of the.
No, I understand. That's a 350. There's a blended, which is a little bit lower, and there's the $300, which is lower yet. But let's just take the high end for the minute. And this is slide 46. Mohegan Sun says we can do 870 million in that same area without reaching outside the PKF market area, which was part of how one got to the 822 million in the HLT analysis. And in addition to that, we can get another 40 million from inflow.
Correct.
For a total of 910. So they're projecting 910. HLT, if I understand this, says there's only 822 million there. Why is their plan insufficient based on their estimate that they can get more out of what we say is less?
It's too aggressive.
Pardon me?
It's outside what we project. It's greater than what we project.
Okay, fair enough. Why isn't then the 822 something that we assume they can get if they're a little bit,
Well,
why can't we assume that they can get the 822? Now, it seems to me, in asking that question, we've got three variables here. We've got the marketing plan, we've got the customer base, afar as opposed to local, which may be related to the marketing plan, and we've got dollar availability in the market. The dollar availability in the market under the HLT analysis is 822 million. The marketing plan may prevent them from capitalizing on that 822 million to the fullest, and they may not be taking the kind of advantage of the foreign travelers that the other applicant is taking. But just in terms of the 822 million, why isn't, with the right marketing plan, that 822 million within their reach?
Well, they're projecting they're projecting a lot more.
I know. And so we say that's overly optimistic. You can't get that. But why is their plan insufficient? Because they're too ambitious.
Do you want to clarify?
if I could clarify.
I must be missing something.
Well, if I could clarify something, Commissioner McHugh, is I think if you want to compare their 870, the 870 is not compared to the 822. The 870 is compared to the 822 minus 76. So essentially is 870 compared to 750. Now, under the 350 revenue per, or revenue per adult basis, that's the high end of the market. If we looked at what Spectrum projected in the state of Massachusetts was actually closer to 300. What we looked at in the benchmark comparisons to Philadelphia and Pittsburgh were closer to 300. So if you really want to compare the 872 or 870, you should also compare the 870 to 705 under the low case minus the 65. So then you have 870 compared to 650. We're talking a $200 million difference in size of market on the one side, up to 100 to $200 million difference in size of market from that perspective. That's a significant amount of or if you want to call it aggressiveness or aggressive view of the market.
So if I understand you correctly, I'm not exactly sure where those numbers came from, but that's not really relevant to the theory. If we look at the primary zone, for example, the max HLT estimates is 561 million. And Mohegan Sun is predicting that it can get 668 out of that. And that is unrealistic, you're saying?
Correct.
Okay. But then why isn't it safe to say that if they're too aggressive with that, they can at least get the 561?
True. No, they can at least take the 481.
Pardon me? No, just stick with my numbers. And I'm sorry. I don't mean to try and rein you in, but I'm just trying to understand that number. If we look at the primary zone number, 561 at 350, and if I understand this correctly, we're saying that is what's there, max.
It's an outside range.
Right.
It's potentially there.
That's right. It's not a firm number. It's an outside range. It's the most that's there.
The most that's there.
Right. And they say, Mohegan Sun says, we can get 668 out of that, and we say, no, you can't, because only 561 is there, right?
Well, essentially, yes. It would require, for them to get 668 million from this area,
Right.
it would require the average adults to be spending significantly more
Right.
than many other jurisdictions.
Right.
Part of the market assessment we did in order to come up with why 300 and 350 was compare what happens in jurisdictions like Pittsburgh, markets like
Sure.
Philadelphia, and there's a methodology, there's a propensity and a number of dollars spent per visitation that results in this number. That would mean that there is significantly more spending by each of those adults.
I understand that. And so why, so we say they can't get the 668 for all the reasons you've just described, but why can't they get the 561?
They could. They could.
Okay, so,
I mean, I would rather you take the 525. And here's why.
and what I'm trying to get to is the ultimate basis for the rating. If they project that they're going to get more than we say is there,
Yeah.
and we say that you can't get that much, but you can get what's there, then how do they get an insufficient rating?
Well,
I understand if it's based on the marketing plan, and I hope we can talk more about that.
We can.
And if it's based on where the money's coming from, local as opposed to afar,
right.
I hope we talk more about that.
Right.
But if it's based purely on you're trying to get too many dollars out of a pot that doesn't hold that many,
Part of this may have been the approach. Let me try to answer this question. Remember my point in a previous slide about the return on investment?
yeah,
The part where we assess the reasonableness of the projections is in the market assessment. But the market, the revenues that they can get have a factor in their return on investment. So we could have said, let's just take your number, whatever here, 561, and given that you've projected that much more, that makes your return on investment a lot less. Because we believe your return on investment is predicated on you assuming that you're going to get these kinds of revenues. So we touch on it, or we do the assessment. We have to fix one and then assess the other one. Otherwise, we could be sort of going in circles. For whatever it's worth, we could say this is take these projections, put them through the ROI, and all of a sudden your return on investment is much less than the 15 or the 17%.
all right, that part I get. So it's not, this isn't being rated in,
Sorry.
this isn't being rated in isolation. This is being rated in the context of the, the overreaching, and I don't use that pejoratively, just to describe trying to get more than's there.
Yeah.
The impact of that on the return on investment and the operating, the operational income and the like.
Right. There's another piece that I think
Is that right?
Yeah, I think so.
Okay.
There's another piece that I think has not Rob mentioned, but let me emphasize. The Region A is, as I've said, I think publicly in the past, is the crown jewel of this state. If there are dollars to be had from out of state, which in my view generate economic development, because otherwise we're just shifting dollars around. This was the one to do it. This is the region that can attract out-of-state players the most. Although I love what MGM has done and proposed in Springfield, their projections show it. There's not a lot of money that comes to Springfield from outside the region. There's a lot of drive time, et cetera, and that is a great regional casino. I believe that there was a big opportunity that they missed, which is the reason of the insufficient, in terms of market opportunity, that they are not realizing in the case of Mohegan. And compared to wind, they really are going for it. So that's a big difference. I think the marketing restriction is a particular piece that I have a condition on that we can talk to if now it's the time. But that's the reason for our assessment.
So
And it's a provisional rating, as we all know.
No, I understand that, and I'm just trying to understand. I'm not, at the moment, I'm not trying to challenge. So part of the basis for the rating is that there is no reaching for what's been described as inflow.
Well, actually, let me clarify this, because inflow, the 40 million that they do, the short answer to your question there is yes.
Yes, we
The
got 260 million in one and 40 million from the
Actually, less than 40. I should go back. That's where I was going. Can you go back? The 40 million that's outlined here, Melissa, go back to the map that shows that one. Part of the 40 million comes from here. Comes from Western Mass, comes
Okay.
from Connecticut and Rhode Island. The inflow that we've always talked about comes from out of everything that's colored here. So there's a number here that we don't know that I have at the tip of my fingers here. There's a number from Western Mass that there are players that should come to Boston from Western Mass that's included in that 40 million.
Okay, I think I understand, but we can talk more about this when we get to the deliberations.
Okay.
Thanks.
I suspected we were going to be over our 2 hours here, but it's important discussion, so.
I have a couple of quick
Yep.
questions on the market assessment. On slide 51 for wind, I just want to kind of break down the folks outside the 30 and 60 and 90-minute window. Outside HLT's market area, I'm assuming you're simply describing as Western Mass, kind of headed anywhere beyond that?
No, if outside the HLT market area, if you look on page 50, that would be New York, Vermont, all of New Hampshire, including Maine.
Okay.
So everything within that red line inside, between the red and the blue line on 50, that's the 56.7 million is from that area.
Okay. Break down for me a little bit further high-yield international players.
Those would be people located around the world that the wind operations know already. They're in their databases. Also, they're always updating their databases. It's those people, and they have 275 marketing representatives located around the world. They will target those people to come to Boston, or a portion of those people.
So this is a number reflected of a portion of their high-yield international players, which I'm guessing currently probably come from China, Asia.
Asia, South
Far East.
America. Asia, South America seems to be their focus right now, a big part of it, but they'd be anywhere in the world beyond the United States.
I mean, I understand that's kind of their bread and butter, but we're trying to get them all the way up to the far east, northeast corner, and they're going to be flying over Las Vegas.
Yep.
So do you take that into account when you come up with that 75 million?
Yeah, no, we took it into account in terms of the magnitude. If it started being like, 150, 200 million, you start questioning. What the applicant stated was that they believe a portion of the international people either have a tie into the East Coast United States, and specifically Boston, through education. They view they could sell the city of Boston as a sophisticated destination, a different gaming destination. So they believe that people on that list are making trips to the Northeast, including New York, and they will tack this on to one of their trips. So it's not they're not going to take somebody specifically and bring them past 5 other properties to come here. They're going to look to see, when are you in this area, and we're going to get you to come.
And just so I understand, the next line of tourism is essentially the market of people potentially visiting Massachusetts already from outside your little HL2 zone that are deciding they're going to go over and
Yeah.
spend some money at the games.
People staying at existing hotels, including the casino hotel, but including, Boston is a very good hotel market, very good occupancy in the fall and certain times of year. They're saying the people that are coming to Boston already, we're going to tap into that to give them an entertainment option. And they're also saying that we should be able to generate some additional visitation to Boston, because now when they choose sort of vacation destinations, now that Boston will have a casino, it's just another part of infrastructure. It's something else to do well in the area.
And one quick question on the Mohegan Sun projections back on 46, only because I haven't got a calculator handy. Can you help me understand the per gaming spend that they're using in their financial projections? And I'm more focused on the primary zone and the secondary zone in New
The actual
Hampshire.
gaming spend that their third-party assessor used was $352. So they're using the high end, roughly $350 for this, all the states of. They actually used it for Maine, all of New Hampshire, all of Vermont, all of Connecticut, and all of Massachusetts. They're assuming that a reasonable spend per adult is $350 as the base market.
Okay. Thank you.
Other questions, or should I just keep going on
Surely.
what should hopefully be the last section, and then I might talk about conditions towards the end. The fourth and final section of the finance review consisted of looking at the operations plan. There's a perhaps discrete, uniquely discrete piece of the evaluation that has to do with their internal controls. And then on the other two subsections, we look at the financial projections as well as some of the costs, as I mentioned, including how they are consistent with their business plans. We look at, for the internal controls, it's easy. There's a lot of documentation that they submitted relative to their internal controls. We did a review of that, a desk review, of course, of the documentation submitted. Next slide, Melissa. We believe that both are very good. They have a lot of experience working in multiple jurisdictions. We provided a lot more documentation in this regard. There's just volumes of documentation. However, in terms of considering this question, it's, the way we approach this is not just what they submitted in this response, but in addition to what they submit, how they operate, and how they the results that they've had over the years, et cetera. So on that note, although Wynn's response was a lot more detailed, with a lot of documentation, I'm rating them both very good. When it comes to the next subsection of the operations plan, we test that the business plan is consistent with the market as we've defined it, and also demonstrates a connection to the financial projections. In other words, we test that what they tell us in their business plan is reflected in their spreadsheets, in their cash flows. We review and assess key components of the plan, look at their strategies for the market. I've talked a lot about the market strategy, but it's important to mention that we triangulate with the budgets, the financial projections, and make sure that they are consistent and start to paint the picture of what their overall business plan and go-to-market strategy is. All of these are responses contained in the finance section. Next slide. In terms of their parking plan, I'm just going to quickly go through these. They both appear reasonable, with slight more spaces, as I mentioned, for the Mohegan Sun, but of course they do have more gaming positions. The slots product plan is reasonable. They both lease around the same amount of games, which also is consistent with what our consultants tell us is the case in other jurisdictions. The table product plan is also both reasonable, especially given, it also reflects the intended local market in the case of Mohegan, and it's really reflective of the high-end market and international play when it comes to Wynn. The hotel plan, and again, all of these details are in the report. I'm just summarizing them here. The average daily rate is consistent with the mid-market brand when it comes to Mohegan. The rate is consistent with the higher-end brand when it comes to Wynn. The retail plan are both reasonable. They incorporate them in the gaming complex. Their food and beverage plan is, in the case of Mohegan, the size and scope are reasonable, but they did not. Neither applicant provided for a buffet, which HLT tells me is something that the customer, the regional market customer, may come to expect. Sourcing, this is a sourcing question. When it comes to Mohegan, they are predicting, or they're counting on sourcing all of their food and beverage. Sourcing some of it is typical, but sourcing all of it could pose challenges when it comes to operational control. If, say, I can give you a quick example, if the tenants decide that the marginal cover after 11 o'clock is just not worth their time, they might close at 11 o'clock, which may mean that there's a high-end play after that hour that may not be attended to, which is something that they come to expect. Marketing plan is consistent with what we just described relative to the typical North American regional casino. And in the case of Wynn, it's also consistent with their market strategy, building on the notion of the higher end and the domestic and international premium customer. I think we talked quite a bit about this already. This is where I was originally planning on talking about the section in the application that details the marketing restriction between MGA Palmer Partners and MGA Gaming, the latter entity that is controlled by Big Brigade. In this regard, there's a notion that if Brigade sells the interest, as I state here, some of the Commission's interest in this regard may not be protected. So I have a condition relative to this marketing restriction that I will talk about in a couple of slides. These we've talked about in some regard. They did provide for what the spirit of that marketing restriction is, but I mentioned already that the notion of standards and procedures would be determined at a later time, the way that they've described it here. There's a specified zone we've talked about is not aligned with the casino gaming objectives. And although the marketing restriction in the case of Mohegan does provide a level of comfort that in respect to the other properties, we would disagree with the representation that it's perfectly aligned with the state's casino objectives, maximizing revenues from going currently out of state and capturing traveling dollars. So to summarize the consistency of the business plan section, the parking, slot, table, hotel, retail plans are all reasonable for both applicants. The market strategy, as I mentioned, is something that we've already talked about. The outsourcing of all food and beverage is not typical, could pose operational challenges, and we've already talked a little bit about the marketing, quite a bit about the marketing restriction. On the other hand, Wynn has a customer, has a marketing plan and a market strategy that focuses on the higher end, not exclusively, of course, and some international premium customers. Although does not have a prominent focus in the local market, we do believe that that may result in some additional food and beverage seats that may be required to accommodate some of the local market that is indeed available.
Could I ask, are you about to go to the next section, Commissioner?
Do I have to go?
No, are you about to go to the next section?
I was, yes, but I can wait.
Could I just ask a couple of questions about the marketing plan, because we've talked now about it a couple of times, and I just want to make sure that I understand a couple of features of it. There is something in the marketing, or maybe this is the operating agreement, I'm not sure what the proper term is, but there's something called a specified zone, right?
Yes.
And the specified zone is a number of zip codes around downtown Boston, right? And the zip codes extend out to about a 30-minute drive from downtown Boston, is that right? And within that 30-minute drive, in those zip codes, Mohegan Sun, the big entity, will turn over to Mohegan Sun, Massachusetts, the names, addresses, and other contact information, and whatever information they have about bettors, people who are known to the Mohegan Sun already. Is that right? Within that specified zone?
No, it's actually, is it within the specified zone or just within the specified zone? Correct. Okay, thank you.
It's just within
Yes.
the specified
Yes.
zone.
Is that, you're talking about the seed,
I'm
seed
talking
database?
about the initial seeding
Yes,
of customers,
yes,
and we'll give that information to Mohegan Sun, Massachusetts.
correct.
And allow Mohegan Sun, Massachusetts to market to those people,
That's right.
right? And the restriction there is that Mohegan Sun, Connecticut can only market to those people within that 30-minute drive time to the same extent
Yes,
that the Mohegan Sun, Massachusetts markets to them.
correct.
So if Mohegan Sun, Massachusetts, for example, and this is a rough example, spent $1 a piece on them a month, then Mohegan Sun, Connecticut would be restricted to spending $1 a month a piece on them as well. right?
Correct.
But outside the specified zone, this 30-minute drive zone, Mohegan Sun in Massachusetts would not give Mohegan Sun, Mohegan Sun in Connecticut would not give Mohegan Sun, Massachusetts, the information
Correct.
that they get. And outside that 30-minute drive zone, Mohegan Sun, Massachusetts would be free to compete with Mohegan Sun, Boston to the fullest extent it wanted. There'd be no there'd be no equivalency, no restrictions, no nothing. Is that right?
Right. There will be no restrictions on Mohegan Sun, Connecticut.
Right. Competing with and trying to attract
That's right.
Mohegan people from those areas.
Correct.
So if Mohegan Sun, Massachusetts spent $2 a month on customers outside that 30-minute drive zone, Mohegan Sun, Connecticut would be free to spend $50.
Yep.
And that 30-minute drive zone includes places roughly outside the 495 belt. Is that fair to say? I mean, that's a rough estimate. It's not.
Yeah. You
Yeah.
want to go to the, yes.
No, I don't need to, I'm just trying to get the big picture here. So that
Yep.
outside the, roughly, let's say, the 495 belt, Mohegan Sun, Massachusetts is free to come, Mohegan Sun, Connecticut is free to come, compete at whatever level it wishes for the customers that live in that area.
Yes.
Inside the 495 belt, basically it's head-to-head competition and both have to wear 8-ounce gloves, something like that. But the restrictions are the same. They have to be balanced. They have to be equivalent to,
Mohegan, Massachusetts sets the bar.
sets the bar. and-
Mohegan, Connecticut can match it.
Can match it, right. Okay, I thought I understood that, and I do. Thank you.
Now, a lot of questions arise out of that, and I guess I already mentioned them.
I look forward to discussing those.
What is that?
Right. Right.
$10 of free play are going to be perceived
Yeah, I understand.
differently.
I just wanted to get the big picture
Yes.
as I walked away from the presentation.
No, you got it. You got it right on.
Okay.
So let's go to the financial projections. If I already did, I already spoke about the prior slide. Financial projections. Mohegan Sun is aligned. If you take the projections and their business plan and corroborate them with their view of the market or their market strategy, they would be in alignment, not what necessarily what the potential we believe is there, but nonetheless, it is aligned. There's also things here that are only summarized in this slide, but detailed in the report. The slot and table game payroll is lower than what would be expected. This is part of the area that I was talking about earlier, where we test some of the costs, some of the projections. The labor costs, as an example, in some cases, I'm not going to get into those details. I believe there's a lot more detail in the economic development section. In some cases, it's actually lower than what MGM predicted, which serves as a great point of comparison. In our belief is that some of these costs would probably be higher for the operation for the Mohegan operation. Although it reads there that the community payments, land rent, and management fees are higher than what would be expected, I'm not talking about the community payments. This is not a reason for this being only sufficient. The applicant has made great strides in terms of dispersing or making commitments to the host and surrounding communities. However, the land rent and management fees in the context of the revenues that we believe are aggressive and the costs that we believe are understated in some pieces are higher than what would be expected. There's something here that I sense, and in general, a lot of value of the application of this operation is being extracted by the multiple parties. and by the promises they've made and the way they've structured the deal in terms of management fees, etc. This is something that I think is worthy of notice, which is that the applicant has assumed that there would still be debt outstanding after the 15-year term, to the tune of $528 million. So this goes back a little bit to the notion that I was talking about earlier. Even though they do have highly confident letters from the bank, from two banks, that say they would obtain financing. And let me actually pause there. Highly confident letter is not a commitment letter. It's not money in the bank by any means. No, we never expected that applicants would arrive to this point with financial commitment, certainly on something of this size. But if I'm the bank, and I'm going to lend on $730 million, and there's going to be only about $400 million going into actual property that I can go after. And at the same time, the applicant doesn't assume that it pays it all back. It's a little bit like something goes wrong. I may not be able to recapture all of the loan, and we talked about the loan to value. And if everything goes right, I'm not even getting paid over the term of the license. There's balance at the end. I, as the bank, with a high loan to value, with the assumption that this is not going to be repaid, might start to get a little nervous as to whether there's enough to repay here. Having said all that, they do have a highly confident letter, as I mentioned. Their revenues, although projected high, in our opinion, we've already addressed that in the market assessment. There is alignment in terms of their business plan and the opportunity of the market. Conversely, WIN has alignment in terms of the business plan and the market. The table payroll is lower than expected in the VIP section, but the margins of the applicant are very different when it comes to the costs that they've assumed elsewhere. And very importantly, in my opinion, the applicant assumes that there would be no debt outstanding at the term of the license, which is also a very good assumption. So let me just read for the record. Melissa, if you can stay with that slide. I'm going to read the next ones because it's very hard to read, I believe. Overall, the Mohegan Sun applicant submitted a comprehensible proposal. They demonstrated that they have access to funds necessary to develop what they propose. There is consistency among the investment, market, and operations as submitted. The project is predominantly focused on penetrating the available market area in eastern Massachusetts and New Hampshire. This market focus, however, is not consistent with why, in my opinion, the state decided to limit the number of casino licenses permitted and impose a low gaming tax rate and a minimum investment threshold. The proposal and strategy, in my view, does not recognize the full potential market opportunity of the Region A location. Also, while the applicant demonstrated the necessary financial capability and operational expertise, the funding plan is complex. There's multiple parties with investment and operational responsibilities. Some of the details have not been finalized. There's various project components that come together by some measures, and I already spoke about these. They are highly leveraged. Commissioner McHugh, to your point, even the common equity is coming, the 50 million of common equity is coming from other investors. This complexity will likely reduce the degree of flexibility that the applicant requires to efficiently and effectively respond to marketplace changes. Those changes will likely occur over the term of the license, but they may very well occur shortly after opening. So overall, the Mohegan Sun proposal is sufficient with one insufficient element, namely their market strategy, as outlined there. Wynn, on the other hand, submitted a comprehensive proposal. In our opinion, they provided a credible plan on its experience, based on its experience in operating casino complexes or casino projects that are in highly competitive market. They're focused on penetrating the high end, but not at the exclusion of the local market. There's regional and international as well. The market focus is consistent with why the state decided to limit the number of casino licenses and impose a low gaming tax rate and a minimum investment threshold. In our view, the applicant, Wynn, recognizes the full potential market opportunity of Region A. They've demonstrated they have the necessary financial capability to develop and operate the proposed project. The funding plan is straightforward. There's consistency among the investment, market, and operations plans submitted. The applicant will directly operate virtually all project components, with the exception of those 4 food and beverage outlets and the retail tenants. Third-party operators will be limited to non-core project components, although they will incorporate some retail if they add market appeal. They talk about Michelin star restaurants. The financial strength of the applicant, including the amount of equity that they commit to the project, is significant. They provide the project, in our view, with the needed flexibility and to efficiently and effectively respond to market changes that will likely occur during the term of the license. Overall, we rate the proposal of Wynn as very good with outstanding elements, namely the ability to obtain project capital, the commitment to spend materially more of the required capital, and the view that the potential market opportunity of the Region A is great. Next slide, and I can pause there. Those were the 2 slides that I just read. Maybe we can leave the one behind. I can pause there for questions or?
Questions, colleagues? Thank you.
I do have the conditions, although I don't know if we need to break for the day or?
No, let's go ahead and do the conditions, and then we'll take a break and wrap this section up. And,
Okay.
and
Do you have that? Let me just preface this by saying that I thought a lot about these conditions. We went back and forth, my advisors and I, as to the parties that come together. I first pondered a lot about the governance of these parties. There will be a notion of a transfer upon award of the license for the case of Mohegan. By the way, my conditions are on Mohegan only. And the fundamental notion here is that the parties agreed to it. So, and we're not interested in, I am not interested for one in trying to recreate the deal. Having said that, what we do have a lot of say, in my opinion, is in the piece that I think becomes compounded and a little bit worrisome, and that is the equity that is available for the actual start of construction. The statute talks about the debt-to-equity ratio that the Commission can set that ratio. We have chosen to not do that by regulation for everybody, I think wisely, because it depends on a lot of things. For one, it changes over time, and I think that's important. And for another, we would not know what to set it as, because for one, the deals can be put together in a very complex and different way. So let's go to the next slide, and the condition that I'm going to build these couple of slides towards is one of additional equity. And maybe, Commissioner McHugh, this is a little bit of what you were asking in the past, or earlier in the presentation, rather. The Mohegan Sun proposes to finance the senior debt here, or to get $732 million to cover the entire project, with the exception of the FF&E, and that is the gaming equipment. Those gaming machines are going to be leased. Those are capital leases, so somebody will have a claim against those first. The third-party hotel and the third-party fit-out is also not included in what they need for their bank loan. So if we take the 1.1 billion total project cost, and we take out, this is a good way to kind of like walk through it. Their stated equity is 235 million. We take out capital lease of 75, that's for the equipment I just talked about. And we take out all the third parties, fit out hotel equity and hotel debt. These are all third parties. And that leaves everything. They have to finance everything else with the bank. They have to start by paying interest right up front, including all of the payments that they have promised, upfront payments that they've promised to surrounding host communities. There's a number of them that come up front. There's a lot of infrastructure spending that has to start happening early on. And those are things that a bank cannot really go after, because that's going to be putting in roads, for example. So let's go on to the next slide. By looking at this slide, we are breaking down in similar fashion. If we start with the 235 million that they've stated as equity, and you take out the 105 million that has been spent to date, there is, and the license fee, there is, but for 45 million of equity available to initiate the project, including a lot of infrastructure spending that I was talking about. The applicant, you might remember, has to deposit 10% of the project costs with the commission, as well as the host and surrounding communities that are around 33 million when it comes to upfront costs. They don't happen immediately, but they happen upfront. So the 45 million doesn't go very far, in my view, when it comes to even beginning the actual construction, design and construction. So as submitted, the applicant current debt to equity ratio is about 5.8%. This, in my view, is a highly leveraged and thus slightly concerning leverage ratio. I've thought a lot about this debt to equity ratio. Something more in line with a little bit more comfort level would be an 80-20. And for that, given that ratio generally as calculated here, would, in my view, for the applicant to achieve this, the applicant would have to obtain $100 million more in additional equity. If we request that and and see what we get as in terms of a response. My suspicion is that some of the parties would have to come back into all those term sheets, and this is something that might not be resolved right away. Something tells me we'll have to see what they tell us. But the commission, I would be looking for $100 million more in additional equity, and then the commission, I would like us to be in a position to approve all credit agreements with the senior lenders. Also, the commission would approve the transfers of ownership, including among existing partners, not just with other partners. So, are there any questions on that calculation? Should I walk through it, or?
No. Questions from colleagues? I understand how you got to that number.
Yeah. Now, in my opinion, what I really would like this equity to do is to be directed to the project, but recognize that there's a lot that they would have to spend, probably in and around the project, and it's all part of, eventually would be part of conditions of the license. But I wanted to put that out there. Lastly, I have a condition on the marketing. Yeah, I got it. Okay. I have a condition on the marketing restriction. The marketing restriction, I probably glossed over mentioning that this is, or didn't gloss over. The marketing restriction is an agreement between Brigade, the entity that Brigade controls, and Mohegan Sun, and I believe the commission should be the one approving the policies and procedures that detail those marketing rules. There's a lot that would have to be detailed. I don't have those. I don't know what those would be, but I would like the commission to be in a position of understanding what those are whenever they are presenting and approving those. My view. My additional condition, or in terms of this marketing restriction, is that Mohegan Sun, Massachusetts is marketed at no less than equivalent basis on the defined market area, not just the one, the restricted zone, the specified zone, but rather all of Massachusetts, Connecticut, Rhode Island, and New Hampshire for the Mohegan's other properties. This would in effect put everybody on equal footing. And, the commission would be in a position to understand and be comfortable that everybody's marketed similarly. I would want that third party to be the commission or the agent to be the one to oversee and monitor the compliance with these marketing policies and procedures, and the costs of oversight and monitoring to be borne by Mohegan Sun, Massachusetts. Those are my conditions. If there's questions about them, I know we'll deliberate about those, I guess, at a later time. But if
Yes,
there's
we'll talk
questions on
about
the
those
clarity-
as a commission on Wednesday. We'll be talking about all of those. So.
Yeah, but I know that they have been presented today for the first time to the applicant. I suspect that this is not something that they can put together right away, but I know that the staff here will try to get an inkling as to how long that may need to, how much time they might need for these kinds of conditions.
The procedure is that we're going to, on Wednesday, talk as a commission as to the conditions that we want to impose, and then, having made that decision, ask the staff to confer with the applicants to see how much time they think they'll need to respond to those conditions. So that's the way we'll proceed.
Okay. Yeah,
Good.
That's right.
All right. If there are no further questions,
Further
thank you.
questions? I can
Thank you
take my
very much,
place then.
Thank you.
Thank you.
Very well
Thank you
done.
very much.
Thank you.
Thank you. So what we're going to do now is we're going to adjourn for the day. It's been a long day, and we're going to adjourn both because it's been a long day and because there's no more time left. But it's important as we break for everybody to understand that what we've heard today is the beginning of a discussion and the presentation of, really not the beginning of a discussion, but the presentation of reports by individual commissioners. The views expressed are the first time some of us have heard these views. The views expressed are not necessarily going to be the views of all of the commission, and it's important for everybody to understand that. We're going to be back here tomorrow morning, and we'll have the next two reports, the next three, really, Commissioner Cameron, Commissioner Stebbins, and then the three of us talking about the overview report. And it's only after those reports are completed that we will regroup again on Wednesday morning and talk first about material errors that may have affected our ratings, and then about the conditions that each of us individually has recommended to the others. So there is certainly a great deal of information for everybody to digest based on today's process, but the group discussion, the group application to those has yet to come. So with that thought in mind and an urging to suspend disbelief until we get to a little further down the road, we'll recess until tomorrow morning at 9 o'clock.